want to thank everybody for attending. We're going to have a great call today. With us is Seth Groff, Life Sales Manager at Assurity Life Insurance Company, and we're going to talk about some of the more popular selling systems out there when it comes to cash value whole life. And I don't want to steal too much of his thunder, so I'm going to hand this over to Seth. Thank you for being with us today.
All right. Well, thanks, Brian, and I'd like to thank everybody for taking a little bit of time to learn a little bit more about Assurity's participating whole life and how it fits into some of the various selling systems that are out there. If you're familiar with the industry, you know, a lot of times you're going to hear sales concepts such as infinite banking, circle of wealth, be your own banker, bank on yourself, and there's all these different selling systems out there. And when you really dive into these different selling systems and you break them down, what they all boil down to is it's just showing clients how they can utilize a whole life plan to fund major purchases. And, you know, with traditional thinking, you know, we're trained because society, we've always done things a certain way. And basically what these sales concepts do is it makes you take a step back, reevaluate the way that we purchase things, and see if there is a better solution to the way that we purchase things. You know, I'm not saying that using a whole life plan to fund major purchases will always be the best solution, but let's just take a look at it and see how it compares to the different alternatives that we have. And so the reason that, you know, people, you stop and think and selling life insurance, especially to a young person, why it's so hard, you know, one thing that I tell agents, or one way of thinking of it is, you know, ask yourself, if you're talking to 30 to 40-year-olds, how many of these individuals plan on dying in the next 20 years? And the reality is that if you ask these people, probably most of them, none of them will say that they plan on dying in the next 20 years. You know, even if you're in a room of people that are 60, they're probably still in their mind they aren't planning on dying in the next 20 years. But if you take a step back and then you ask these individuals, well, how many of you plan on purchasing something over $10,000 in the next 20 years? Most people are going to say yes, right? They're either going to buy a car, they might buy a house, they might fund their child's education, whatever the case might be. But it isn't unrealistic to expect that you're going to purchase something over $10,000 in the next 20 years. Well, the follow-up question to that is, how are they planning on financing it? And, you know, I almost guarantee that they're either going to say, well, we'll probably have to take out a loan, or they'll say, well, I've been saving for it. Well, what if I can show you a more efficient way to purchase this item over $10,000? Is that something that you'd be interested in? And obviously, the answer to that is yes. And so today, a lot of these concepts, you know, whether it's infinite banking, be your own banker, circle of wealth, a lot of these concepts, they go across all these different selling systems. I'm not specifically looking at any specific system today, just a general concept and overview of the various systems. But one common thing that all these systems have is that the first thing you have to make people realize is that we finance everything we buy. And what we mean by that is that if you go out and buy a car, a lot of people are going to go down to the bank and take a loan out, right? And so they have to pay interest. And so people get that. They realize that they have to pay interest, and that is considered financing what they buy. But what they don't realize is if they take the alternative method, that if they save up their money and then basically go and pay cash, that they're actually financing that purchase too. Because in addition to losing that principal that they've saved up, they've also lost the opportunity cost that if they went and invested that money someplace else. And so we finance everything we buy, and you have to realize that, because we're either paying interest or we're losing opportunity cost, and we want to take a look at a way that we can recapture some of that opportunity cost. When you look at these selling systems, the biggest thing you have to remember is that this is not a get-rich-quick scheme. The longer you have these policies, the better they look, and this is a concept, this is a system, and if you've read Nelson Nash's book, Becoming Your Own Banker, you'll realize that he will say this is a generational concept. The longer you have these policies enforced, the longer you can get, you know, the next generation working on them as fast as possible, the better off you're going to be. So if you're looking for something where you can just get rich quick, from a client standpoint, this is not the best place for it. It is going to take time. It is going to take discipline. Also, you have to think like the rich. And what I mean by that is you have to learn how to leverage assets and how to leverage money. And I always use an example about Donald Trump. And if there was 10 hotels for sale and each hotel was $1 million, and let's say Donald Trump had $1 million in his pocket, and he walked up there and saw these hotels for sale, 10 hotels for $1 million, and after talking with them, he thinks he can sell them for $2 million. Donald Trump doesn't take that $1 million and purchase one hotel and sells it for $2 million and only makes $1 million. What Donald Trump does is he would take that $1 million, take it to the bank as collateral, borrow, basically $10 million, go out, buy the whole lot. He might have to pay $1 million in interest, but when he sells them, he makes a profit of $9 million. And that's the whole concept of utilizing the cash value in a whole life plan to fund major purchases, is you're going to leverage that cash value for whatever the case might be. Maybe it is purchasing something. Maybe you're pulling that money out and investing in somewhere where you can get a better return than what the interest on the account is charging. But the bottom line is that you're using that asset, you're leveraging that asset for other financial purchases. And that's the concept that you have to realize, and that's the concept that the rich do. They use other people's assets to make money. And if you look at the banking system, and how it works, and the banks don't lend their money. In order to start a bank, you have to have a lot of assets, right? But the bank doesn't lend their money, or at least they don't lend out all their money. They get deposits from you and me, right? We go out, we try to get deposits from customers. Once we have, we'll say, well, if you give us our money, you put it in this bank, we'll give you an interest rate of, let's say, 3.5%. But what they do after they give you that 3.5%, what do? They turn around and they loan it out for maybe 5%. And so banks, they keep the economy going. When the bank stops, the whole economy stops going. But you have to realize that they're not loaning their money. They're loaning yours and my money, and they're making the money on the spread. And if you can apply that same concept to your whole life plan and play the numbers, where if you can take money out, get a higher interest than what you're being charged, and then pay yourself back, you're going to be able to make it on the spread. So you have to understand banking, and you have to understand that spread in order for these policies to work. But remember, the flow of money, it keeps the economy going, and that's evident back in 2008 when banks stopped loaning money for houses. When the mortgage market crashed, basically everything came to a stop. So you have to keep that in mind. You have to understand that flow of money, because we're going to be taking loans against our policy, paying it back, and utilizing that money. And the more times we can utilize that money, the better off we are going to be. The other thing that you have to remember is that banks don't lend because you have collateral. They lend because they think you can pay. And you have to have that same concept and that same mentality when you're borrowing against your policy. You have to have that concept that I'm going to pay this back. So I mentioned it earlier. If you're going to set up one of these policies as a banking policy, you have to be disciplined, and you have to ask yourself if you're going to be a good business owner. Because if you're not going to be a good business owner and you're not going to be disciplined and you have this money, you would actually be better off just going out and paying cash. Excuse me. But if you're going to be disciplined and a good business owner, this is a better way to go. And what I always tell people is, think about going out and opening a business. And in this example, let's say we're going to go out and open up a business for a bar. And in order to open up that, I have to get a place to sell to have my bar, but then I also have to buy inventory. And let's say, excuse me, let's say that we go out and buy 100 bottles of beer for $2.75 a piece, and I'm going to sell these bottles of beer for $3 a piece. I have to turn my inventory, or I have to sell 92 bottles of beer just to break even. Everything after that is going to be strict profit. And if I can turn that inventory enough times, I'm going to make a profit and have a successful business. But let's say that one of my friends walks in, and my friend walks in and they expect to get a free drink, right? Well, if I give him one free drink at $2.75, I actually have to sell 11 beers just to break even. But if you change that mentality of thinking about having to give your buddy a beer and realize that he's a captive customer, meaning that since he's a friend, he's going to come there anyways, you can actually charge him more. And so if I charge him more at $3.25, I'll have to sell $85 to break even, or 85 beers to break even. But the reason I tell that story is because you are going to be the business owner, and then you're also going to be the customer on this policy, meaning that you are going to be a captive customer. And if you charge yourself more interest than in theory, so if you pay back your loans faster than if you go to a bank, you're going to be better off in your policy, because the quicker you pay off that policy loan, the better your policy is going to look. And so you have to be a good business owner. You have to repay the loans, and if you're not going to repay the loans, you're better off to go out and do it somewhere else. But if you do repay the loans, I'll show you how you can recapture some of that lost opportunity cost. If you're going to start a bank, you have to go out, you have to have money, you have to get a charter, you have to have a building, find someone to make deposits, and then lend the money to someone that will pay. Well, a lot of us don't have this opportunity, but we can set up a whole life plan that will allow us to do this. And this is going to be a strategy that's going to be more realistic for most of us out there. So instead of going out and going through all those steps to set up a participating whole life plan, what we can do is we can utilize a participating whole life plan. A couple of things when we set up these plans, we're setting them up to maximize cash value and minimize the death benefit. And in order to accomplish that, what we have to do is we have to add the value enhancement rider. And what that value enhancement rider does is it's going to turbocharge the cash value, and it's going to turbocharge the death benefit. And so we're going to add so much of that value enhancement rider that we're going to snuggle up to that MEC line. Now remember, we don't want this policy to be a MEC, because one of the advantages of using this strategy is that we don't have to pay taxes when we access the money, as long as we prevent it from becoming a MEC. So we're going to snuggle up that line, but we're not going to cross it. Also, you need to use a participating whole life plan, because you're going to use that dividend to continue to build up the cash value. And in order to have a participating whole life plan, it has to be a mutual company. And the good news is that Assurity has a plan that fits perfect into this strategy. So what we're going to look at an example of purchasing a car. And I always say, if you like this concept, if you want to talk to people and show them how they can recapture some of that lost opportunity cost, you need to focus on a place that your client is losing interest or losing money. And the obvious solution is going to be on a car, right? And so I always use a car example first, because that's a place that most clients are going to be losing money. And so I talk to them, and let's say that this particular client, and then the example that I'm going to use is I'm going to use a 30-year-old male, and let's say that he wants to go out and he wants to purchase a car every 20 years, or he's going to purchase a car for $20,000 every 5 years for 20 years. Okay, so basically throughout this 20 years, he's going to purchase 4 different cars. Let's look at the different options that he has to purchase these cars. First, he could lease the car. And I know a lot of people do lease vehicles. I'm not saying that it's wrong. I'm just saying that, if you look at it, at the end of 20 years, you have no equity, and you have no car. And some people say, well, yeah, I have the option to buy the car. And I'm not getting into the argument about, the different lease options. All I'm saying is that you have to do additional things in order to get the car. If your original lease agreement, you pay for the car. At the end of the lease, you trade it in and get a new one. So, in Nelson Nash's book on infinite banking, he says this is the least favorable way to go out and purchase a car. Obviously, you can go out and take a loan. If you go out and take a loan at 5% interest, and you look at a 5-year note, basically you'd pay $377 a month, or $4,534 a year. The total paid on that over 20 years would be $90,000. You receive $80,000, so you pay basically $10,000 in interest. But not only did you lose that interest, you lost the opportunity cost on that interest, and then you also lost the opportunity cost on that $80,000 if you were to go and invest it somewhere else. So, taking a loan against the policy is going to be the second least favorable option. Then people say, well, okay, I get it. I get going out taking loans are bad because I pay the bank interest. So they say, I'll save up, and I'll save up and then go out and buy the car. So assuming that you can get 3.5% interest in someplace safe, like a CD, which you probably can't right now, but let's just assume that you can get 3.5% interest. I went out and calculated the opportunity cost of purchasing those cars. So the first one, because I purchased that one immediately, in over 20 years, this is the opportunity cost over 20 years, not the opportunity cost over, you know, the lifetime. But that first car, I lose 20,000 of opportunity cost. The second car, I lose 13,000 because that's over 15 years. The third car, my opportunity cost, I'm going to lose 8,366. And then my fourth car, opportunity cost is 3,818. So my total opportunity cost for those 4 cars is 46,201. Okay? So obviously, you know, you look at that and you say, okay, I get that, but what's a better way? What if we go out and we can purchase a participating whole life plan? How would that plan look? And if we use whole life, and I'm going to use a different strategy, and I'm going to tell you right now, this strategy is even different than the last time I did this webinar, but it seems to make a lot more sense. And I'm going to show you that we are going to compare this to another type of investment. But basically, I say to the client, what if you can start your bank? What if you can, you know, like a business, if you start a business, it takes time, right? You have to build up the cash value. Well, what if we build up this policy? Let's say you drive your current car for 7 years, okay, in this example. Can you, you know, how good is your car? Can it make it another 7 years? Let's say we can get your cash value built up in this plan, and we're not going to take a loan until after 7 years. So we're not going to start the cycle until after 7 years, but let's look at how this compares. And I just want to point out that I am going to show it compared to the same thing as an investment alternative here in just a second, because you'll say, well, yeah, but you're starting this policy with $35,000. What I'm going to show you is that your balance after you purchase those 4 cars is going to be $88,776. And if you subtract out that $35,000 that you used to start, you know, your cash value, you're actually going to net $53,776. So remember, on that previous slide, our lost opportunity cost over 20 years was $46,201. And if I do this strategy, not only do I recapture that entire opportunity cost of $46,000, I'm also going to even net even more because I have $53,000. So I actually even recapture more opportunity cost than if I just went out and invested it. But here's what I mean by that. And I'll show you. I'm going to actually go out and show you an illustration because this will make more sense with the illustration. But if we go out, we look at my illustration software, and I already have a example already loaded up. Actually, I'm going to go back here just to show you what I'm doing. I got a 30-year-old male, pretty straightforward illustration, 30-year-old male. And when I come out, I already have this set up. But this individual, basically what we're going to do is we're going to start our bank, okay? And so this individual says I can contribute $5,000 a year on an annual basis. And what we're going to do is we're going to start this bank for the initial 7 years and then start the loan process. And so if you look here, what I've done is I've done reduced paid up after 7 years. So he's 30. After 7 years, I'm doing reduced paid up. And so after that 7 years, he's not going to have to pay any more premiums in this plan. Okay, that's when the banking policy is going to get started. That's when he's going to go. A lot of times they're going to want to continue to pay the premium. In this particular example, for illustrative purposes, I did stop the payments after 7 years. You can see that I did a max accumulation solve. What this does is that this is going to determine the best ratio of base premium and value enhancement rider. Remember that value enhancement rider is going to maximize the cash value, maximize the death benefit, and if I go out here and I'll show you on an actual illustration what I'm talking about. When I come out here, and remember he was doing $5,000 a year, you can see that out of that $5,000 a year, approximately $1,865 of it is going to the base policy. The remainder, over $3,000, is going to the value enhancement rider. This is going to be the best ratio of base policy and value enhancement rider to maximize cash value. Okay. The other thing that I want to show you in this particular example is, remember, I said that we're going to take loans, and here I illustrate taking loans of $20,000 every 5 years for 20 years. Right? So you can see after I contribute to this plan for 7 years, I take that first loan. Then obviously no money is coming out. After 5 years, I take another loan of $20,000, and I repeat this process 4 times so that it's the best way to, or I'm going to illustrate 4 loans coming out of this plan. The other thing that you have to remember is that I'm going to repay this, right? I'm going to repay the loan at the same schedule that I'm repaying that bank. And if you go back and you look at that PowerPoint, how much would you have to pay if you took a loan? You'd have to repay it $4,534 a month. And that's not a coincidence. Basically, that's the same amount that I'm going to repay my policy. So in order to have the same repayment schedule as the that I would have to get at a bank, I'm going to set it up with a surety. I'm repaying this policy loan in the same manner. Okay, so that's what I have set up. Taking out 4 loans, repaying the loans at the same rate that if I went to the bank and borrowed it at 5%. You know, I just calculate that out, go out onto the internet, and figure out what the loan repayment schedule is. But now I'm going to go out and look at this policy and see how it actually looks. So if I come out to the illustration, first thing I want to point out is, remember, we got this thing capitalized by putting $35,000 in, $5,000 a year for 7 years. So at that point, you can see that the premiums stop, right? The premiums stop. We still have access to the cash value, and we still have a death benefit over here, but the premiums actually stop. Now, if you look at so if you go down and you look at this, what I want to point out then, in year 8, we take a loan of $20,000. You might say, well, yeah, but over here when I'm looking at this, it looks like that loan is only $15,000. Well, remember, we're going to start our monthly repayment of this loan immediately, because if you went to a bank, you'd have to start your loan immediately. So by the end of the year, the surety will actually write you a check for the full $20,000, but the software just nets it out, because we're assuming that you're going to start those monthly payments of $377 immediately, and you're going to continue them until the loan is paid off. So as you can see, we repay this in the 5th year. The reason this number is less is because we've repaid the entire policy loan, so we can't put any more money into the plan and still keep that favorable tax status. So the software automatically knows it, our system automatically knows it, and when they say, sorry, you paid too much, then we come back and tell you to stop making loan repayments. But as you can see, we basically repeat this strategy for 4 years. So you can see 4 loans coming out. We repay all 4 of them. At the end of those 4 years, we still have $88,000, $776,000 into this plan. So that was the number that I used on this illustration. So you can see that basically if we use whole life, we started our bank $35,000, same loan payments as if we went to the bank, but at the end of it, we have a balance of $88,776. So we've netted $53,000 on this portion. The loan part of it, that's the same thing that we would have had to done if we went down to the bank. So that's the same alternative, and we still end up netting $53,776. Now, I know what people say. People come back to me and say, well, Seth, yeah, but when you're doing the loan example, you saved up or you put $35,000 into this plan before you started taking a loan. And I say that is true. Let's look at an alternative of putting it into an alternative investment and doing the same thing, because if you get it capitalized, it's going to make a big difference. Well, let's look at save and pay. Remember, we did 3.5% interest on the save and pay. So let's say we do capitalize with that $35,000 over 7 years and put it into a place where we can receive 3.5% interest. How does that compare with the whole life? And I'll show you here how that compares. One thing that a surety has, and that if you're licensed with premier companies, they can get you a copy of this. But one thing that I use to compare to other investments is it's called InSmart. In this example, I'm just going to go out and show you how easy it is for me to compare it to a different alternative. So I've already ran the actual InSmart illustration. Basically what I'm going to do is I'm going to compare this whole life plan to if I had any taxable investment where I earned 3.5%, okay? Now, maybe it's a CD, whatever the case might be, but let's just assume that it's a taxable investment, 3.5% over the next 20 years. How does that compare? Because remember, if we went to the bank, that's what we're illustrating. That's realistic with a 5% loan. But let's go out and look at how it actually compares. And so I can come out and I can see, you can see that this illustration is actually going to have any taxable investment, and you can see it's 3.5% yield, income bracket of 28%, but you can see the any taxable investment over here on the left, LifeScape Whole Life over here on the right, and let's just look at what we got going on here with this particular illustration. So if I scroll down, you can see that we're going to have a little bit, this is your any taxable account. You can see that in the early years it's actually going to be higher than the other, the whole life. Over here on the left you can see we have the same payments going into both of them. Basically we have that initial $35,000 dumping in and then taking the $20,000 loan, repaying it over the course of 20 years. But really what I'm interested in is I want to see how they compare at the end of 20 years of taking loans. So we funded it for 7 and then 20 years of taking loans, and you can see that the cash value on the whole life plan is $88,776, right? We already looked at that. If you earn 3.5% on the other one and you capitalize your account by putting $35,000 into it before you start taking it out, at that 3.5% interest, it's only $68,190. And so in both these examples, we did the exact same thing. One, we just took money out of that investment to buy the car. This one, we took policy loans, and you can see that you have about $20,000 more cash value if you go the whole life route. In addition to that $20,000 additional in the cash value, you've also had this death benefit the entire time. Remember, this strategy over here, just putting it into some other account, you don't get the death benefit, but in this example, you do. And so as you can see, it has a better payoff over the course of that 27 years. And if you're interested in what you'd have to match, what type of investment you would have to match the whole life to fund these major purchases, you'd actually have to earn a 5.33% over that 27 years in order to do it. And to match the death benefit, that's over double what you'd have to do. And so if you look at that, you can see that the whole life option is going to be a better solution. And so going back to the actual PowerPoint presentation, you know, there's what I was showing with that investment alternative. Your balance after 4 cars is $68,000. You put $35,000 into it. You net $33,528. You compare that back to the whole life, and you're netting, you know, like I said, about $20,000 more. And so to fund major purchases and to use that selling systems as infinite banking or Circle of Wealth, this is what it's all about. It's about recapturing that lost opportunity cost that you lose when going to the bank. And a whole life plan will allow you to do it. But the biggest thing that I have to be able to point out to you and why you should consider using a surety is that, you know, we have software that is built for these types of sales. We have this max accumulation solve that I already talked about that will, you know, automatically calculate the best ratio of base, premium, and value enhancement rider. And then we can get as detailed as we want with loans and withdrawals to see what's the best option for the client. And when you're talking to them about them and you're showing them how to recapture that opportunity cost, they're going to want to see some actual numbers for their particular situation. You know, so I go out to Google. I use a lot of the financial calculators out there just to calculate lost opportunity cost. That's pretty easy. But, you know, if I want to see how the actual policy is going to perform when I take out loans and repay them so I know how much cash value I have in it at the end, you know, our software is set up to do it. So with that, Brian, I will go ahead and turn it back over to you. But that basically wraps up my presentation on, you know, on understanding how you can set up these policies for the infinite banking policies, Circle of Wealth policies, where you're funding major purchases using the cash value. So with that, Brian, I'll turn it back over to you.
Thanks, Seth. We're starting to get some questions rolling in. If you have any questions, use the chat feature, or you can ask a question through the chat feature there. But first question is, what is the interest rate on the loan?
Yeah, the interest rate on the loan right now, let me pull it up. I believe it's 4 point, I think it's just shy of 5%. I can pull it up here. Just hold tight.
And while you're getting that pulled up, I'll ask the second question that's come in. Do you guys, what's the dividend credited interest rate to the account?
Well, the dividend interest rate is 5.25, but remember, it's the way that dividends work. It's not like a UL plan where it's actually credited to the policy. That dividend rate is what's applied to the dividend formula, and so it's not applied directly to the account. But 5.25 is what we're using in that dividend calculation. And our interest rates right now for the month of April is 4.76, and it's 4.68 for the month of May.
Okay, let's give it a little bit more time, see if there's any other questions coming in. Asking if we can receive a copy. Yes, this session was recorded, so you reach out to a life marketer after the call. You can get a copy of the recording, or you can reach out on our website. Click on the YouTube logo on the bottom of the page, and that's our YouTube channel link, and this will be on there. And I don't see anything else, Seth. So if you have any other questions, Seth's got it on the screen. It's 800-365-8208. Just ask for a life marketer. Yes, the recording, the YouTube link is a recording that shows the slides as well as the audio. Oh, another quick question. What percentage of the cash value can be taken out in a loan?
That's a good question. It comes out to roughly a little bit over 90% of the cash value. Normally what we're going to keep in that cash value is we're going to make sure that we have enough cash value to pay at least the interest on 1 year. So when you look at it, it comes out to roughly about 90% of the cash value.
We got a state availability question. I don't know if you know off the top of your head, but New York, Connecticut, California. Are we approved in there?
We do no business in New York. So New York, no, we don't have any products approved there. Whole life is approved in those other Connecticut and California, and that value enhancement rider is approved there as well. So we could do this concept definitely in those 2 states.
A couple other questions rolling in here. What is the first year you can take a loan out?
You can take loans out immediately. So basically, as soon as the policy is issued, you can take policy loans against your, loans against your policy. One thing to keep in mind when you do that, there has to be cash there. Okay. So if you add that value enhancement rider, which is essentially the paid up additions rider, whatever you put into that rider, that pretty much is liquid immediately. There's a little bit of a load that comes off of it that first year, but that portion of it you would have access to that basically as soon as the policy issued if you want to take a loan against that amount.
All right, great. Well, once again, if you have any other questions that come up, our number is on the screen, 800-365-8208. Ask for a life marketer. Thank you, Seth, for your time today, and we appreciate everybody else taking their time to be with us. Have a great day.
Bye.